Your credit score is a 3-digit number that follows you everywhere. It can decide whether you're approved for a car loan, what interest rate you get on a mortgage, or even whether a landlord rents you an apartment. The problem is, most people don't even know what goes into that number. And if you don't know, how are you supposed to take part in controlling how good or bad your score may be? Let's break things down simply. Your score is built from your credit report. That's really just a record of your loans and credit cards, when you open them, and whether you've paid on time. 3 companies called credit bureaus, Experian, Equifax, and TransUnion, keep these reports. Think of them like record keepers. 5 main factors build your score. The first and biggest factor is payment history. This makes up 35% of your score. It's the simple question: do you pay your bills on time? Even one missed payment can drop your score by dozens of points, and it can stay on your report for up to 7 years. For example, if you forget a $100 credit card bill and pay it a month late, that one slip-up could cost you thousands in extra interest over the life of a car loan. The easiest way to protect yourself is to turn on autopay for at least the minimum payment, or set reminders on your phone so nothing slips through the cracks. The second factor is credit utilization. This is 30% of your score. It's a fancy way of saying how much of your available credit you're using. Here's the math. If you have a card with a $2,000 limit and your balance is $400, you're using 20%. That's solid. If your balance is $1,800, you're using 90%, and that's a red flag. The rule of thumb is to keep utilization under 30%. Under 10% is even better. One quick trick is to make an extra payment before your statement closes so the reported balance looks lower. The third factor is length of credit history. This counts for 15% of your score. It measures how long you've had credit. Your oldest account, your newest account, and the average age of all your accounts all matter. Older accounts are valuable. That's why it's usually smart to keep them open, even if you don't use them much. Closing your oldest card can shorten your history and lower your score. The fourth factor is credit mix. That's 10% of your score. It asks whether you've handled more than one type of credit. Credit cards are called revolving credit because the balance goes up and down. Loans, like car loans or student loans, are installment credit because you pay a fixed amount each month until it's done. Having both types shows lenders you can handle different responsibilities. But don't go out and take on a loan just for variety. Let this happen naturally as life requires it. The fifth and final factor is new credit inquiries. This is also 10% of your score. Every time you apply for a new card or loan, the lender checks your report. That's called a hard inquiry, and it can nudge your score down a little for about a year. Soft checks, like you looking up your own score, don't hurt at all. If you need a new card, that's fine. Just don't apply for 5 at once. Space them out. Let's recap. Payment history, pay on time, always. Utilization, keep balances low. Credit history, the longer the better. Credit mix, a little variety helps. And new credit, don't apply too often. Focus on the first 2. Together, they make up 65% of your score. If you protect those, you're already ahead. Your credit score doesn't have to be a mystery. It's just a trust meter built from your habits. Keep promises, keep balances light, and go easy on new applications, and your score will follow. To make this simple, I put all of this into a free credit score cheat sheet you can download right now. Grab it using the link in bio or in the description. And if you found this helpful, hit subscribe for more easy explanations of the world of adulting.